Good day, I'm Dean Jansen from Rensburg from the Efficient Group. In today's session, we'll discuss public sector funds. Efficient Wealth, they can assist with many financial products. They can assist with medical aid, short-term insurance, long-term insurance, estate planning. But in today's session, we'll focus on retirement planning as well as investment management with a specific focus on public sector funds. Efficient Wealth, they've got a national footprint where they can assist with your specific financial needs. I'd like to hand it over to Candice that will discuss our financial planning process at Efficient Wealth with a specific focus on public sector funds. Thank you, Candice.
Thank you, Dean. Good day, everyone. At Efficient Wealth, we follow the 6 steps of the financial planning process to develop a plan that is tailored to each and every one of our clients' unique circumstances. The benefits of the financial plan is to provide our clients to make informed financial decisions in all aspects of their lives. This will ensure that they achieve their short and medium-term goals. Let's look at step 1. Step 1 is client engagement. Step 2 is where we gather the data, including the client's goals. Step 3 is to analyze and evaluate the client's financial situation. Step 4 is to develop and present the recommendation. Step 5 is to implement the recommendations. And step 6 is to monitor and review the client's portfolio on a quarterly and annual basis. Okay, so I'll be discussing the public sector funds based on Formula C. Before 1 March 1998, all lump sum benefits payable from public sector funds to the members were exempt from tax. The Income Tax Act introduced tax on public sector funds from 1 March 1998. This only applied to benefits built up from 1 March 1998, or commonly referred to as pre-1998 vested rights. In order to determine the taxable and tax-free portion, it is necessary to apply Formula C, as you can see below. So let's look at an example. This is Mr. Allen. He's currently 58 years old. He's an SAA pilot, and he is a member of the Transnet Retirement Fund. He started in the 1st of February 1990, and his retirement date 31st of May 2020. That would give him 30 years of pensionable service and 22 years of services after 1998. So he also contributes to a Grant Thornton Provident Fund. He has a primary residence and holiday property. Formula C will only be applied on the Transnet Retirement Fund. Formula C will only be applied to the amount taken in cash at retirement, and a maximum of 1/3 may be withdrawn. So let's look at the first diagram. 1/3 and pay tax. So 1/3 would go into a discretionary fund and 2/3 into a living annuity. The client will therefore pay 632,500 cash. Take the optimal amount in cash, the reverse formula will be applied. Therefore, the client will invest 681,818 in a discretionary fund and 9,318,082 in a living annuity. It is also important to know that at retirement, the client will be taxed on the retirement tax tables, which is 500,000 taxed at 0%. Okay, let's look at the income at retirement. The Grant Thornton Fund will be transferred directly to the living annuity, and the cash flow diagram will show the split between the discretionary fund and the living annuity. The client will therefore have a net income of 40,724. The cash flow illustration will show that the client's income will increase with inflation and will be sustainable for 25 years. Let's look at the resignation option. Where the member exits the fund because of resignation from service, the member has two options available. Receive the full fund value as a cash resignation benefit or transfer the full fund value to an approved retirement fund. Just to make a note that Formula C will apply on the full fund value on resignation. So diagram 3 is where Mr. Allen would resign and retire. So at resignation, the client will take the tax-free amount in cash, transfer the remainder to a preservation fund, and then retire from the preservation fund, take the tax-free of 500,000, and the rest will go into a living annuity. And let's look at the income. Again, the Grant Thornton Provident Fund will be transferred directly to the living annuity. Here you would see that the cash flow diagram, the discretionary portion would have a higher amount and the living annuity will have a lower amount. And the client will have a net income of 45,920. This will also ensure that the client's income is sustainable for 25 years, which increases with inflation. It's also important to note that at resignation, the client will pay tax on the withdrawal tables. So let's look at this diagram. This is only a guideline. So this is to ensure that you select an income at a level that would be sustainable for the rest of your life. You need to carefully consider the income with your financial advisor, and the drawdown has to be relative to your return on your investment. So let's look at it at an example. If you had to draw 5% and the investment return was 9%, your income would be sustainable for 25 years. At Efficient, we also have different annuity options, and this would obviously depend on the client's circumstances and their lifestyle. So there's a living annuity and a life annuity. So let's start with the life annuity. A life annuity, your monthly income will depend on the life insurer's rate. This is a fixed rate, and your income will also depend on the initial investment. The annuity will be paid for life, but you also, the disadvantage is you don't have flexibility to choose your own funds, and you cannot nominate beneficiaries or even increase your income. So let's look at the living annuity, where most people invest their money in. So you can choose your own income. Members can choose how much income to withdraw between 2.5% and 17.5%. The income may be adjusted once a year on the anniversary date. It's however important to know that living annuities will form part of the investor's taxable income. You also have control and flexibility. Members of a living annuity may select their own underlying investments. The member and their financial advisor are therefore reminded to carefully consider the overall composition of their living annuities in terms of the exposure to these various asset classes. Deanne will explain how Efficient structure their post-retirement funds. And then lastly, with a living annuity, you can nominate beneficiaries. Any money left in the member's living annuity when they die can be left to their beneficiaries. Nominated beneficiaries can opt to receive the income based on the remaining investment balance or request that the total investment be paid out to them. Thank you.
Thank you, Candice. So at Efficient Wealth, we have a dedicated investment team that's responsible for market and fund research. So boutique investment partners, they do the research for us. they give that research to the Naviga Investment Committee that is responsible to build the portfolios. I mean, the Naviga operational team is responsible to implement that portfolios, to monitor it, report to clients on a quarterly basis, and to provide investment support. So boutique investment partners, they consist of a highly qualified and experienced investment team. They manage in excess of 40 billion rands. The investment committee consists of myself, Davie Ruet, the chief economist, Pierre de Klerk, and Mitzi van Westhuizen from Boutique Investment Partners. So we have a range of solutions to cater for the specific needs of an individual, and we'll go through some of those solutions in the following slides. We prefer to use the silo approach for our clients' post-retirement investments. We split the assets between a short, medium, and long-term silo, and we only draw the income from a short-term silo. Within the short-term silo, we target to outperform the average money market fund by investing in flexible income fund managers. The target here is CPI plus 1% over a short to medium term. With a medium-term silo, we take slightly more risk by investing in equities, and the target here is CPI plus 3% over medium to long term. And then in the long-term silo, we invest 100% in equities, both local and global, and we might also add property to this long-term silo. We can use both share portfolios and unit trust within this silo. The target here is to achieve long-term capital growth with a target return of CPI plus 6% over long term. We combine different in funds with different investment styles to improve the consistency of our portfolios. So we don't only select one specific style, but we combine different styles, for example, quality, value, momentum, and size, to have a better outcome for our clients. We also diversify between different types of asset managers. We invest in both active fund managers and passive fund managers. That reduces the cost of our portfolios. When in the active space, we also split it between boutique managers that's smaller and more nimble and flexible, and they can more actively manage the funds than the large active fund managers. And as I mentioned, we also include either index exposure to reduce the cost of our portfolios. Within the different asset classes, we can offer enhanced cash mandates for the cash component. We prefer to use flexible income managers to get exposure to SA bonds. Within equity, we can use both share portfolios and unit trust funds. On property, we can include both local and global. And when it comes to the offshore exposure, there's low limit within a living annuity. We can invest more than 30% in offshore assets if it meets the needs of our client. On fees, it's important to understand what you're paying for. So the focus here is on the total investment cost. So this is the fees that you pay for the underlying investments. It consists of a total expense ratio, which is the management fees, performance fees, VAT, and other costs like custody, trustee, audit, and bank charges. So this is the fee to run the fund, and also if the asset manager outperforms the benchmark, there might be performance fees applicable. In addition to this, there's also a fee for trading the underlying instrument. So there's a cost involved for buying or selling shares in the portfolio, and that is the transaction cost, or TC. This all adds up to the total investment cost, and this is total fee that you'll pay for the investments for the asset manager, as well as operational costs, as well as the trading of the underlying instruments. It is important to note that a fee is not an indicator of future performance. We've used two funds from the same asset manager, 91 Opportunity, 91 Manage, and we've split up the fees for each fund. For Opportunity and Manage, the total expense ratio, so that's the fee of running the fund, is similar. Both have a similar fee, whereas the performance fee differs between the two funds. The 91 Managed Fund outperformed the Opportunity Fund, and therefore the performance fee of managed is slightly higher than opportunity. Both funds outperform their respective benchmarks, and that's why there's a performance fee. Transaction cost is higher for managed because they follow a momentum strategy, so they are more active in their fund, and therefore there's a higher cost involved in buying and selling of the stocks. Within 91 opportunity, they tend to buy stock and hold it for the long term, and therefore the cost is lower. So the total fee for Investec Managed is more than double that of 91 opportunity fund. But despite the higher fee, 91 Managed outperformed 91 opportunity during the last 5 years. So it's important to note that a high fee is not an indicator of future performance, and what is important here is to understand what you pay for. If a fund manager is more active, the fees might be higher for those funds that are more active. But funds, for example, index funds that is not active, which is a passive fund, their fees must be lower because there's no active management involved. They buy the market and they stick to those holdings for the long term. So the cost of the index fund must be less because there's no active fund management. So understand what you pay for and make sure that the fee relates to the investment mandate. If the style is a buy and hold strategy, the fees will be lower, but a manager that's more active, the fees might be higher. Just so understand the link between the fees that you pay and the investment mandate. All service providers also need to quote the effective annual cost. So this is all fees related to the investment. So it includes the total investment cost, like we discussed in the previous slides. It includes the advice fee, administration costs for the admin of the investment, as well as other fees. In this case, it will be a model portfolio fee for Naviga. At Efficient Wealth, the portfolios vary between 0.67 and 1.3% TIC. The advice fee will vary between 0.4% to 0.58%, and that includes VAT. And the fee will be determined by the investment value. The admin fee differs between 0.12% at the low end to 0.46% on the high end. And once again, the admin fee will be determined by the investment size. And then the model portfolio fee is 0.23%. We use many different types of platforms at Efficient Wealth, and it depends on the specific needs of a client and also the investment size, because we use the platforms that's cheapest for a client's specific needs or investment. So that concludes today's session on public sector funds. If you have any questions, please email us and we'll get back to you. Thank you. Good day.